Thanks for joining. This is Mo Valley Funding. My name is Marcus. I'll be going over some of the main things for you as a small business, as an entrepreneur, to get your business going and to grow your business. You want to know what lenders are looking for when they approve you for financing. Now, business financing is a very integral part in growing your business. It can be a challenge, particularly when you're a startup, and lenders tend to be cautious when you are a startup. So obviously what they want is to make sure that you can pay them back. Now, when it comes to business lending, there are several options. They include traditional lenders like banks, online lenders. I'm sure you're familiar with them. Then there's micro lenders, also the SBA, the big name, the big elephant in the room. So what do loan applicants need to supply to get these loans? Lenders generally want to see that you have enough assets. They want to see you have sufficient financial reserves and enough personal collateral to ride out business fluctuations, as business fluctuations are inevitable. How do loan applicants demonstrate these things? Well, borrowers need to show a solid cash flow sufficient to repay the loan. They need to show a track record of profitability, and they need to demonstrate success in a similar business endeavor. So, in other words, they have to prove what is called credit worthiness. Credit worthiness. Now, this isn't easy to prove when you're starting out. Now, how do borrowers prove they are credit worthy? Well, for startup entrepreneurs in particular, they'll need to demonstrate by using other means. They'll need to demonstrate that they're credit-worthy business owners by some alternative means without having cash flow or collateral. Now, one way to prove they owned or managed a profitable business in a different industry. So previous success will definitely help. And this means bringing in a resume, maybe financials from an earlier venture. They may be able to show this is that they can supplement their own experience with that of someone who has, more experience in the field. Now, this means bringing a partner in, maybe an angel investor or a mentor, preparing to meet with the lender. That's also important. A borrower should have the following items: a sound business plan. That's very important. Now, any financial information they can provide on their business, information on their personal credit, often that's going to be the big difference in securing the loan, your personal credit as well. Now, what goes into a sound traditional business plan? Well, it varies depending on your industry. It's not going to be the same if you're a laundromat versus a restaurant, but a traditional business plan, whether they are, a laundromat or a pizza joint, they have the same components: an executive summary, description of the company, market analysis as well. Very important. Now, business plans also include data on the company's organization and management. It's going to include a description of the service or product line, marketing and sales data. Startups won't have that much. If you're a startup, you're not going to have a lot of sales data, but they should have handled on how their market is going to proceed. Now, the plan will also include the company's actual funding request, their financial projections, and an appendix, which will include all supporting documentation. Now, these are usually shorter than traditional plans. They include information on key partnerships, activities, and resources, the value proposition, the customer relationships and segments. Now, they also include communication channels, cost structures, and revenue streams. Now, part of a traditional business plan will include an executive summary, a brief overview of your company, your product, your executive team, future plans for growth. Also, company description. You want to get into details about your company, what problem it solves. Market analysis as well. How are you different than your competition, and how are you going to do better than your competition? Now, company organization and management. What's your business entity and who does what? Service or product line. Not only what you sell, but also future plans and even patents. Marketing, sales, and data. Uh, what are your strategies to attract and retain your customers? You got to look at all those things and present that to any lenders you have. Now, the company's actual funding request, that's very important. You want to be able to itemize and clearly show how you are looking to spend those funds once you get them. Now, financial projections, and that includes income statements and the like if the company is already established. Now, if you're a startup, it's a little different, but if not, this is a place to list collateral and an appendix. Here's where you add licenses, permits, patents, things like that. Key partnerships. If you have some partnerships, which suppliers, manufacturers are you working with? Key activities. How will your company gain a competitive advantage? Key resources. List which resources you'll leverage to give your customer value. That could include personnel, intellectual property, capital. A lot of different things actually. Now, value proposition. You got to think about which unique value will your product or service bring to the market because the lender is. Customer relationships. What will the customer experience be like in person? Will it be online or something else? In customer segments, who will your business serve? Do you have a good handle on your ideal customer? What are they like? What are they watching? What are they doing on Facebook right now? Communication channels, how you speak with your customers, how you optimize communication in the future. Cost structure, will you be trying to maximize value or reduce cost? Regardless of strategy, how much is that going to cost you in the long run and short term? Now, revenue streams, very important. Now, how will your venture actually get to the money? Direct sales. You're going to get membership, subscription, selling ad space, what have you. Now, financial information on a business, apart from the business plan and its contents, you'll need a profit and loss statement, a P&L. That's profit and loss statement. Very important. According to Investopedia, financial statement that summarizes revenues, costs. You can look it up yourself, but there it is. It's a very detailed look at a specific period of time, usually a fiscal quarter a year. And these records provide information about the company's ability or lack thereof to generate profit by increasing revenue, reducing costs, etc. And there's a link if you want to look that up yourself. Get a little help with that. Usually people go to accountants for that kind of work. Now the P&L or income statement, one of 3 quarterly and annual statements a company makes as to its financial health. Now the other 2 are cash flow statements, the balance sheet. Now, there are numerous blank P&L forms online to help you out, but the idea is that the P&L is going to show changes in the account over a specific time frame, and that way it's similar to a cash flow statement. This is not like a balance sheet. A balance sheet is just a snapshot. Now, a P&L will give you a handle on the money your business has, and how much capital is coming in and going out. And it's good for more than just yet another piece of paper to give the lender. Monthly and annual revenues, online lenders in particular want this kind of data. It shows not only what your company makes, but also any trends or even seasonality. Bank balances, online and offline lenders particularly want this data. It helps show not only trends, but it also shows responsible money management. It's another way of showing seasonality. Now, the power of knowing your numbers. The power of knowing your numbers is vital to running any profitable business. You can make any necessary adjustments to show a profit. Of course, the numbers are not going to lie to you. They tell you everything you need to know about the health of a business. The numbers will. So knowing your numbers means you have a huge advantage over any business owner who does not know their numbers. Now, your profit and loss statement tells a story of a unique business. Understanding the story behind the numbers, that's very important, an extremely important factor for you to achieve success perfectly. Now, personal Credit information, lenders will often want to see your FICO score. Now, this is particularly the case for sole proprietorship, startup companies. They want to know if you're experienced in, paying back loans or if you default on your obligations. Now, for online lenders in particular, time in business matters. Of course, a startup has no time in business, but other ventures do, because so many businesses fail in their first year. And creditors, they want to know this. Now, lenders are often looking for a means of securing the loan. Now, this protects them in case you default on your obligations. Unfortunately, collateral and other means of securing loans can be done creatively. Use your assets as collateral. Rates are often 5% or less when you're using collateral. And personal credit rating will not matter if you have collateral. Some types of collateral you can use, of course, your 401k, any stocks or bonds, existing inventory, accounts receivable. That's a huge one. Now, they may let you leverage your assets in exchange for a percentage of your business. They usually want less of a percentage of your company than a VC would, but essentially they'll be acting like an angel investor. That's a bonus if they can mentor you in business, so that could help, but not always going to be helpful. 401k financing, use an existing 401k or IRA as collateral for your business financing. Pay no tax penalties. You still earn interest on your 401k. Low rates, often less than 5%, and they fund close in less than 3 weeks. So usually you can get up to 100% of what's rollable within your 401k. Securities-based financing, that's something else that we offer here. Now, you can, use your existing stocks as leverage to get business financing. You can borrow as much as 90% of the value of your stocks. You can keep earning interest on your stocks pledged as collateral. So, and again, closing and funding less than 3 weeks. Security-based financing, you're going to get 70-90% loan to value. The rates are kind of like mortgage rates, so 5% is common, but you only pay interest on what you borrow. This is a working capital line of credit and works for challenged personal credit as well. Now, there's also inventory financing. So you can use your existing inventory as collateral for business financing. Now, sometimes you'll need inventory valued at $500,000 or more. You can get approved for a line of credit for 50% of inventory value. Rates are usually between 5 to 15%, depending on the type of inventory, and funding is usually within 3 weeks or less. Minimum inventory loan amount, $150,000. General loan to value, about 50%. So inventory value needs to be about 300,000 or more. So it can't be lumped together with other inventory like office equipment. Accounts receivable financing, you can use outstanding accounts receivable for financing. You can get as much as 80% of your receivables advanced ongoing in less than 24 hours. Now, the remainder of the accounts receivables released once the invoice is paid in full. Closing takes less than 2 weeks. And factor rates are as low as 1.3%, 3%, somewhere in there. Now, it is a credit line with rates of less than 1% with no consumer credit requirement. Receivables should be with the government or another business. Now, if you have, purchase orders, you can get financing to have those filled. You won't need to use your cash flow to do so. Now, you can get forwarded up to 80% of receivables and usually you have to be in business for a year. That's not always the case. Now, these must be receivables from another business, rates of 1.2 to 5%. Other collateral options include company's equipment. You can also use invoice factoring. Invoice factoring is not quite a loan. Instead, you sell your outstanding invoices to a factoring company. They collect directly from your customers. If you're in the trucking industry, then you're probably very familiar with factoring. Personal guarantees. That's another option, is a personal guarantee, and that's exactly what it is. Your personal assets are at stake. But sometimes, particularly for startups, you'll have to do that. Microloan, that's another option. You can't get a microloan from a regular lender. Instead, you get a microloan from a microlender. So you could try the Association for Enterprise Opportunity to find a local microlender, microenterpriseworks.org. SBA, that's another option for you. Usually need to show some time in business for SBA loans. They're the most popular loan for working capital. Approvals up to 750,000. Rates are usually 2 to 4% above prime rate. And all owners with more than 20% ownership must provide a personal guarantee. Good consumer credit is required. So recap what lenders look at to approve you for financing. And lenders want to be sure your company can pay back its obligations. They want to know your business is a going concern. And they want to see if it's succeeding or if it should be. Borrowers need to prove their credit worthiness. Documentation is crucial. Virtually every lender wants to see a business plan. Business plans can be traditional for startups, and they have different sections. Lenders want a P&L, profit and loss. They usually want some sort of collateral or personal guarantee. For any more information, feel free to give us a call at 1-800-410-1050. Thanks.